title of today's presentation is Risk Issues for Banks, Current Areas of Priority, and we titled it Bridging the New Normal, where post-pandemic there are quite a few changes that have happened in the risk landscape, and in the monetary and fiscal side of the economy, we've seen a lot of movements that are causing us to look at risk issues in a different way today. So while today's sessions are focused on risk management and measurement with the trends and drive towards digital technologies and related digital priorities, this first session is really meant to anchor the discussion in overall market dynamics and fundamentals, where we are in the cycle, as well as present a bit of a point of view from TCS as to credit risk and some of the emerging concerns that we have in that area. So we're going to present a high-level overview and postulate some possible outcomes or scenarios, and we'd be pleased to answer questions and receive input on credit risk challenges from the audience. Obviously, as we go through this presentation here or afterwards, when we are offline and this video is posted, feel free to connect with me. It's always good to expand our networks, especially around topics that require a good deal of analysis, collaboration, and complexity. So I'd invite all participants to look me up on LinkedIn and connect so we can keep the conversation going, particularly around topics that you might find interest from today's event. We plan to hold these CRO discussions on a routine basis moving forward. So connecting with us now through LinkedIn or through email or through Premia or through other methods would be great. You could help drive some of the content in future sessions. So if you're interested in working with us to establish content and topics, please reach out to participate. So with that, I want to get into the body of the presentation. If you look at some of the numbers from the capital markets, it's really astounding the degree of debt which has accumulated in the system. If you look just at the United States, you can see since the global financial crisis, we're at a significantly higher level of debt across the board than where we were at the beginning of the global financial crisis. This is particularly attenuated to the rise of federal debt, which has been almost exponential. If we look at federal debt and we just see the almost vertical rise in federal debt since 2008, 9, 10, we also need to look at global debt and then talk a little bit about what this means for the system. Global debt since the beginning of the pandemic has increased around 30 trillion USD. That's about a third of global GDP. Just an astounding amount of debt, especially when you consider the fact that total US public debt is around 30 trillion. We've literally accumulated the equivalent of the United States public debt again globally once over, which has just added to the debt pile that already existed when we entered the pandemic. So a lot of the monetary and fiscal support has served to drive rates even lower, which has created an increase in risk appetite across the board and driven a lot of asset prices up. So global debt now stands at an historical record of 290 trillion, which is about 3.5 times global GDP of 84.5 trillion. So just an astounding amount of global debt, and really an unsustainable path. And when I mentioned a moment ago about how this has driven asset prices, we can see that, interest rates go down, fixed income prices go up. We can certainly see that in mortgages. We saw that in 2006, 7, leading up to the 2008 mortgage crisis. If you look at just U.S. mortgage prices year over year, they've increased over 20%. These are the same sorts of high valuations that you saw in 2006-7 leading up to the mortgage crisis, but now we're seeing this not just localized in the US, but if you look at Canadian mortgages, if you look at mortgages in Europe and in the UK, if you look across the globe, what we've really seen is a coordinated effort to deal with the pandemic through coordinated monetary and fiscal actions, the result of which has been driving up asset prices and weakening current currencies. I mean, the dollar has been a flight to quality refuge, but that firepower is coming under additional stress as we move into 2022. I think it's also important to note the increase in debt in China's property market. We saw earlier this year some stresses and strains in the Chinese property market. The amount of debt that's been accumulated in that market over the course of the last decade has been phenomenal and presents China with some unique challenges with regard to systemic fragility, which I think is going to be important to watch as we proceed as well. China certainly accumulated a lot of debt over the years, and dealing with that is going to be a challenge for them in the coming quarters and years. Total household debt, just to emphasize that point, in China has grown from 2010 by close to 7 trillion. When you compare that to other emerging market economies and other economies, it's just a phenomenal rate of growth. And I just wanted to point a couple other things out just on market context before we get into the meat of the presentation. But if you look at, and this was one of the measures that I like to look at, which is the rate of debt growth versus GDP growth, you really can't grow debt faster than GDP and expect responsible fiscal and monetary prudence. Prudential actions. It's an unsustainable combination. And so when you look at the total amount of federal debt that's been issued over the last 5 years, you're basically looking at an increase in issuance of debt of about 12.4%, where GDP growth has been about 2.1%. So debt growing about 6 times the rate of GDP growth, which is just unsustainable, and put us in a precarious position for rising interest rates. So the amount of interest rate risk that's in the system is certainly pronounced, and we're at a period of time where a lot of the managers for interest rates within institutions are young enough that they've never grown up in a period where they've had to deal with rising interest rates or inflationary risks that are also a part and parcel of the official sector actions that have occurred over the last 16 to 18 to 24 months. So with that as context, I wanted to move into the next section, which will lay out some of the key drivers that are occurring in the market right now and how that relates to bank operations specifically. So some of the macro trends that I wanted to cover today include historically low margins. Right now, we're at a point in time for banks where, in the United States at least, the net interest margin is at a historical low. For banks over $10 billion, that number is somewhere in the neighborhood of about 1.8%. I remember when I was growing up in banking, a net interest margin of 3.5% was about the 50th percentile. That was considered a healthy, solid, but about average net interest margin. Of course, since that time, I'm kind of dating myself a little bit, but since that time, there's been a secular downward pressure on margins, and banks have had to look at other ways to supplement their spread income, net interest income minus interest expense. So they've had to look at ways to supplement their net interest income through non-interest revenues, sources, wealth management, and other activities. because the margin has been low for a long time. And given the zero interest rate policies that have been kind of a necessary consequence of the pandemic, we're seeing and have seen a lot more risk appetite and a lot of yield chasing as a result of these low policies. So we've seen banks extend the maturity of their assets, particularly in the investment portfolio, going out a little bit longer. Thankfully, we've also seen an effort in a lot of organizations, in part due to the net stable funding rule, to push some of those liabilities out as well in order to offset and to match that asset liability profile. But nonetheless, banks are in a position where their margins are under a lot of stress. The result of which has been exacerbated by the extraordinary support from the post-pandemic recovery efforts, both from the fiscal side and the monetary side. And with the amount of risk in the system, I think although we were surprised at the degree of, I don't want to say ease, but surprised at the resilience of the system in the face of the COVID-19 pandemic, looking forward and looking at all the risk signals that are blinking, I think it's important for us to be prepared for, financial risks that perhaps, given the state of affairs in the system, we've not seen before. So staying in front of potential financial pandemic is really important, meaning, gaining insights and staying ahead of the risk wall is really crucial. And while I think we can all agree that the economy has shown remarkable resilience over the last 18 months, it's fair to say that the speed and traction of the recovery has been, I think, a surprise to everyone. Employment among low-wage workers is still down 30% from pre-pandemic levels, but higher wage earners have fully regained their lost jobs, and the labor markets continue to improve. So we do have this K-shaped recovery, but nonetheless, the economy's shown remarkable resilience, particularly with regard to asset prices and the creation of additional wealth through rising asset prices. Nonetheless, the pandemic does present urgent and unique challenges, particularly with regard to managing and measuring credit risk. In particularly, the important public support measures and flexibility put in place as a result of the pandemic truly could be masking underlying credit issues. Combine that with other issues we're facing, like inflation, rising interest rates, and other challenges in the supply chain, narrow risk spreads, excess liquidity. It could be easy to ask, where's the risk? When you look at credit risk, it looks like the industry's saying that they believe that credit risk is low. We're seeing reserve releases. Non-performing loans appear manageable and under control at the moment. There's been an increased focus, and I think rightfully so, on loan servicing, particularly, creditors and obligors, both on the retail and the commercial side, that need additional assistance and forbearance as we come out of the pandemic, but also increased focus on fraud and climate risk related issues, and a recognition, I think, fundamentally, that the monetary and fiscal actions have truly distorted a lot of the market fundamentals, resulting in a lot of the macro trends that I'm showing on the screen here. Low margins, strong liquidity and capital. That's directly a result of the public policy support that's occurred. I think the reserve releases and non-performing loans, all of the issues here has been a result of really public policy actions that have ultimately distorted a lot of the market fundamentals. So with that in mind, what's a risk manager to do? From our perspective, we believe it's really back to the basics. And one of the areas that we're focused on are establishing robust risk controls that allow a bank to gain a line of sight into potential credit deterioration, pandemic induced or otherwise. Today, when we speak to CROs and credit risk officers, they want to be able to look through their portfolio stratifications to credit analysis and to obligor level details, so they're not lulled into a sense of complacency by any kind of masking effects. So looking at portfolios by segment, by geo, by industries, by asset quality indicators, early warning indicators, and other performance trends has never been more important. So one of the areas that we've paid a particular attention to is the advent of and the creation of early warning indicators, asking questions like, what does the underlying credit worthiness of the borrower look like when public policy support is withdrawn? What will be the effect of credit performance of borrowers after the pandemic ends? Will some borrowers have more permanent damage from the pandemic due to structural changes to the economy? Were some borrowers, and this was, I think, very true, were some borrowers already weak coming into the pandemic, and time really hasn't helped them improve their credit worthiness, and all we've done is foreborn the zombie companies, and this is going to rise up and present an emerging and increased challenge, both on the corporate side and on the retail side. So we won't just have some challenges on, let's say, from the GFC, the global financial crisis, a challenge in the mortgage space, but we'll also have a challenge in corporate and other areas. That being said, early warning indicators of credit events can significantly reduce expected losses. Not all banks have sufficiently strong credit risk practices in place to make the banking sector resilient, but early warning indicators, financial institutions are finding that with the advent of fintech, AI, and machine learning, there are methods for assessing portfolio and obligor risk that are unique and changing. While still cash flow based, the ability to analyze patterns through cloud analytics and algorithmic operations is allowing for continuous enterprise learning. After all, that the algorithms work even while we're asleep. So building that early warning indicator system that's leveraging things like neuro-linguistic programming or natural language programming or natural language generation can be really important additions to your arsenal of early warning indicators, allowing close to real-time updates to risk indicators because they're working all the time. So banks are rethinking how to better and more accurately inculcate EWIs into their processes, and categorize and monitor indicators across risk types using the vast sums of data that they've collected in efforts to improve dramatically on risk decisioning. And while traditional measurements are critical, such processes can be somewhat slow to react, somewhat brittle in times of crisis, and lacking in timeliness and depth. So some of the things that we like to see early warning indicators include are on this slide. On the right-hand side of this slide, you'll see a chart, and what it's showing are two banks, Bank 1 and Bank 2, where they've got the same exposure, and at default, the exposure at default is the same, but as they transition towards a workout over the course of, let's say, 9 months, the credit that had as part of its path dependent state when it got to the exposure of default point The credit that had a history of early warning indicators and interventions with the client tends to have significantly better recovery results. So the loss given default is lower than those credits that did not benefit from any early warning indicator. This graphic is from Oliver Wyman, but it shows that the difference can be as much as 40 points different in recovery rate, which is just a really significant improvement to overall loss experience of financial institutions. So one of the areas that we've been focused on with virtually all of our customers has been this concept of credit benchmarking, which, given everything that we've spoken about today, the amount of debt in the system, the distortions that have been created through the unique and unusual monetary and fiscal actions that have taken place by the official sector, a firm really must focus on providing throughout its enterprise a credit benchmarking service to its frontline and portfolio management staff across the full life cycle of retail and commercial credit. So this slide is meant to show some of the things that are consistent with the idea of credit benchmarking. When we enter into these engagements with clients, we might not pick all of these buckets, but what we're trying to do is build a dashboard that's as real time as we can get across your portfolio and segments and geographies and products, counterparties, in order to not only better service those segments, but to get ahead of any kind of risk wall that's coming our way by looking at things like negative economic events, which could be scanning news, scanning internal data for outdated credit assessments, covenant violations, things like high line of credit utilization, looking at things like account payable delays. There's a variety of different things that we can do. Using all that to create metrics and KPIs and a variety of other tools, all of which is meant to drive this lower result, which is loss in the event of default. So we think that it's important to have not only that risk awareness, but that your ability to assess that risk is mobile, given post-pandemic period that we're in. Today, it's more important than ever to be risk aware everywhere you're at, whether you're on the road or at home, but in the palm of your hand is where your access to your portfolio and your risk awareness should be. With all of the things in the center box, integrated audit trails, it should be mobile, secure, and resilient, and provide all of these other capabilities. But the key point is that it's digital, it's mobile, and allows for the management of risk everywhere, because we're moving into a period of time where the speed and rapidity, scale, depth, and integration of risk movements across the system are likely going to be higher, and so the need to react and respond to those risks in a rapid and proactive fashion has never been greater. So with that, I'd like to express my appreciation for being able to provide this introduction. I'd like to thank the participants, and as we move on to the rest of the conference, I know we're going to have a lot of meaningful discussions. So I want to say thank you for this section, and I'm going to turn it over to our next speaker. Thank you very much.